everyone, hope you're all having a great day. In today's video, we're going to be talking about how to pick the right stocks, brought to you by our team No Broke Anymore. Please be informed that we're not in any partnership with any organization, nor are we promoting a specific stock. We're a group of individuals focusing on helping everyone learn the nuances of the financial world and how to save money and be a pro. We publish financial contents every day, so please do support us by liking, following, and subscribing our page. Let us move on to the topic. How important it is to choose the right stocks for you. There are various factors which determine on how to pick and invest in stocks. Also, an individual's personality plays a huge part in making investment decisions. Depending on the requirement and age, the choice of investment might differ. For example, if you are in the age group of 25 to 35 where the goal is to make fast cash and huge profits, then short term scalping might be right for you. However, if you're in the age group of 50 and above with retirement plans and portfolio investments, then swing trading low volatility stocks might be more appropriate. Regardless, there is a certain amount of risk, capital, and various factors which determine the investment process. Now, let us take a step back and then analyze each factor to come to a better conclusion. Factor 1: Growth rate of the company. The first element an investor should focus on is the growth rate of the company that they want to invest in. There should be consistent growth in the firm. If there's a lot of dips and curves in the graph, then it is safer to keep such companies away from the investors list. The reason being that in gradual growth of the company, the stock prices consistently increase without higher percentage of risk of loss. The more consistent the profit and growth is, more the values of shares will increase. Factor 2: Debt analysis of the company. The second major component is the debt analysis of the company you want to invest in. We can get all the financial statements and records of the organization from the internet, or we can pay a certain amount of fee to procure such records. To analyze the debt status of the organization, one can use various financial ratios. Let us now focus on few ratios which can aid in this analysis. Debt to equity ratio. Every investor looks for a company with low debt to equity ratio as it shows the ability of the company to stand strong in adverse scenarios in the economy. During the economic slowdown, many companies having high debt failed to garner profit, and the companies with less debt stood confident. The debt to equity ratio is calculated by total liabilities divided by the total shareholders' equity. The debt to equity ratio is considered ideal for a company from zero point 0.5 to 1.5. High debt to equity ratio indicates excess use of debt funds for financing the requirements of the company. Such companies are liable to generate volatile earning for their investor when the interest obligation of the company surges. If the company is having high debt, then it will restrict the ability of the company to generate surplus cash. Also, the fact that it affects the shareholders' profit as the profit gets distributed only after fulfilling the debt obligations. The low debt companies are able to carry out the course of action quickly as they are free from managing debtors and the debt. These are the reasons why the investors are attracted to companies having low debt to equity ratio. Factor 3: ROE, or return on equity. Post debt analysis, another aspect one can consider before investing is the ROE, or return on equity. Return on equity is a financial performance indicator that determines the profitability of a company. It is computed by dividing the net income by the shareholders' equity. Shareholders' equity represents the company's assets minus its liabilities, and therefore ROE signifies the return on net assets. It serves as a measure of both company's profitability and its effectiveness in generating profits. A higher ROE indicates the company's management is proficient at generating income and fostering growth through equity financing. As an investor, it is important to evaluate and compare the ROE of different companies before making any investment decisions. For example, a general thumb rule for any investment is to focus on companies whose ROE is equal to or slightly higher than the average of their competitors. For example, let us consider a case of Netco Limited, which has consistently maintained an ROE of 19% in the recent year. In comparison, the average ROE of its peers stand at 15%. This suggests that Netco Limited has been able to generate a more favorable return on its equity compared to its industry counterparts, making it a potentially attractive investment option. An important note while considering this is too that it might not directly affect the share prices immediately, and that the share prices depends on a multiple market factors such as demand and supply, the trends, the trade cycle, market conditions, and the political factors, etc. Factor 5: Background of the company. Post all such analytical researches, it is vital to learn more about the background of the company. One can get the details of the current board members, directors, and all other information from their company website. Apart from this, it is an investor's duty to learn about the products and services provided by the company to know if it has a sound corporate social responsibility and also a great reputation in the public, like Tata Groups. Following closely on the news updates or any court cases pending against the company before any solid decisions would greatly help the investors. Factor 4: Fair pricing of shares. Let us now discuss the fair pricing of shares and how this plays a major role in assisting to build the right portfolio for you. In layman's term, a fair value of shares is determining if the investors are paying the correct value for a share. Understanding a fair value depends on the individual's mindset, and there are certain methods by which we can determine the fair value of shares. One such method is the PE ratio. The best method to calculate fair pricing of shares is via price to earnings ratio, that is the PE ratio, which is a valuation metric used to assess a company's worth by comparing its current share price to its earning per share. It is also referred to as the price multiple or earnings multiple. Investors and analysts use PE ratios to evaluate the relative value of a company's shares in standardized comparison. This enables them to make apple to apple assessment between different companies. Additionally, PE ratios can be employed to compare a company's current valuation against its historical performance or to make comparisons between different markets or different time periods. The price to earning ratios is one of the most widely used tools by which investors and analysts determine the stock's relative valuation. The PE ratio helps one determine whether a stock is overvalued or undervalued. It is very important to note that while calculating PE ratio, historical analysis from up to 5 to 10 years is vital, as this shows the consistency in the PE ratio throughout the years. This past analysis helps us understand the trend which might carry for a foreseeable future. Factor 6: Competitive advantage. Competitive advantage is a special unique characteristic an organization has that makes it outshine its competitors. When a competitive advantage is sustainable, it becomes more challenging for competitors to diminish or eliminate the advantage. The sustainability ensures that the company can continue to benefit from its advantageous position, creating a long term value and potentially outperforming competitors in the market. By maintaining a sustainable competitive advantage, a firm can secure a stronger position and deliver greater value to its shareholders. So, it's very important when choosing a company, a investor should consider a competitive advantage as a factor. In conclusion, upon completion of your research process, you may find yourself with either a single investment opportunity or a list of 10 or more potential companies to consider. Alternatively, you may conclude that the industry itself is not suitable for your investment objectives, which is perfectly acceptable. In fact, all the research you conducted may have prevented you from making a poor investment decision. Recognizing when to decline an investment opportunity is a critical skill in the realm of stock selection. You may feel confident and prepared to proceed, or you may choose to conduct a comprehensive analysis of the financial statement akin to a seasoned professional in the financial industry. It is important to recognize, however, that these screening steps can help narrow down a list of potential investment options. They should not be seen as a substitute for conducting a thorough fundamental analysis. Screening can be a useful tool to filter out the stocks that do not meet your predetermined criteria, such as financial metrics, industry performance, or growth prospects. The process allows you to focus on stocks that have a higher profitability of aligning with your investment goals. Nonetheless, it is crucial to recognize that the comprehensive fundamental analysis, which delves deeper into a company's financial statements, competitive positioning, management quality, and other key factors, is still necessary to make a very well informed investment decision. So, the combination of both approaches can provide a more comprehensive understanding of potential investment candidates and increase the likelihood of making an informed investment choice. If this video helped you understand the basics of picking the right shares to invest, please do comment and share this video to your friends to educate them also. Stay woke, stay rich from the team No Broke Anymore.